Bitcoin is hovering just above $92,000 as the most bullish stories on the market are getting quietly revised lower. In this video, the focus is on why big institutions are cutting their price targets, what ETF flows are really telling you, and whether this is just a healthy pause or the end of the bull run. Bitcoin is trading around $92,157, slightly below recent highs. And for the first time in months, the market's most optimistic voices are starting to turn cautious. A top strategist at a major global bank has just slashed Bitcoin targets for 2025 to 2027, and that is forcing traders to rethink the always-up narrative. Over the last year, the story was simple. ETFs, institutions, and digital asset treasuries would keep buying and push prices towards six-figure levels. Now, the data is showing something very different. Inflows are slowing, volatility is shrinking, and ETF investors are starting to take money off the table. The question now is whether this is just consolidation before the next leg higher, or a sign the bull cycle is already peaking. Right now, Bitcoin is trading in the low 92,000s, a few $100s below the previous overnight high. The intraday range is relatively tight, with buyers stepping in on dips but struggling to push price into a clean breakout. This kind of price action is classic consolidation. Candles are overlapping, momentum indicators are cooling, and the market looks tired after an intense run earlier in the year. Instead of explosive moves, traders are seeing controlled pullbacks and quick mean reversion, which often signals that both bulls and bears are waiting for the next major catalyst. One of the big headlines weighing on sentiment is the decision by Standard Chartered's lead crypto strategist to cut Bitcoin price targets across the 2025 to 2027 window. That strategist had previously been one of the loudest voices behind aggressive upside scenarios, using ETF demand and institutional adoption to justify very high levels. The new call points to ETF inflow fatigue and pressure on the balance sheets of crypto-focused companies that loaded up on Bitcoin at higher prices. Instead of assuming endless demand, the bank now argues that many treasuries are overexposed and more likely to trim positions into strength than add aggressively at current levels. This shift matters because when one of the most bullish banks turns more cautious, it can trigger a broader repricing of expectations across the market. For months, spot Bitcoin ETFs were the hero of every bull thesis. Investors watched billions pour into these products and concluded that Wall Street demand would drive a structural, unstoppable uptrend. Recently, however, those flows have slowed, and in some sessions even flipped to modest net outflows. ETF fatigue does not mean investors are suddenly bearish, but it does mean that the strongest marginal buyer is no longer pushing as hard as before. When inflows flatten out while price sits near record territory, upside becomes harder to sustain because there is less new capital chasing the same number of coins. That sets the stage for sideways movement, choppy ranges, and sharper reactions to negative headlines. Another important piece of this story is the condition of digital asset treasuries held by crypto companies, miners, and some listed firms that chose to park part of their balance sheet in Bitcoin. Many of these entities built large positions when prices were lower, but they also faced rising costs, shrinking margins, and higher funding rates during the last cycle. With Bitcoin near the upper end of its range, some treasuries are under pressure to lock in profits, reduce volatility on their balance sheet, or free up cash for operations. That creates a source of natural selling into strength, even if the long-term view on Bitcoin remains positive. When major holders stop accumulating and start trimming, the market loses an important tailwind and is forced to rely more on retail and shorter-term traders. On the other side of the debate, research house Bernstein is still defending the idea that Bitcoin is in an extended bull cycle rather than near a top. Their argument centers on the macro backdrop: easier policy over time, growing institutional familiarity with digital assets, and the long-term effect of supply shocks like the halving. From this perspective, the current consolidation is not a threat but a necessary reset. In a long bull market, price often runs ahead of fundamentals and then pauses while earnings, adoption, and liquidity catch up. Bernstein's thesis suggests that as long as broader risk appetite remains healthy and regulatory risks stay contained, Bitcoin can continue trending higher over a multi-year horizon, even if the path is choppy. One of the most striking features of the current market is how quiet it has become. Realized and implied volatility in Bitcoin have both compressed compared to the wild swings seen earlier in the cycle. Daily percentage moves are smaller, ranges are tighter, and many options traders are pricing in less dramatic short-term scenarios. Compressed volatility can mean two very different things. In a maturing market, it can signal that price discovery is slowing as more institutional capital helps stabilize moves. But it can also act as a coiled spring. Long periods of low volatility often precede sharp breakouts when a new catalyst finally hits. Traders watching volatility know that the longer Bitcoin stays pinned in a narrow band, the more energy can build for the next major directional move. Taken together, the evidence points more toward consolidation than a sudden year-end melt-up. The price is stable but not exploding higher. ETF flows are mixed rather than euphoric, and even some of the most bullish institutional voices are dialing back their expectations. At the same time, there is no sign of panic selling, no cascade of forced liquidations, and no collapse in liquidity. This balance between cooling enthusiasm and still supportive fundamentals is exactly what consolidation looks like in a bull market. The market is digesting gains, rotating ownership from leveraged hands to stronger holders and waiting for the next narrative. That could be a new wave of institutional adoption, a macro surprise from central banks, or a fresh regulatory breakthrough that unlocks more capital. For active traders, the key focus should be the range around current prices. A decisive break above recent highs with strong volume and renewed ETF inflows could signal that the consolidation phase is ending and the next leg of the bull move is starting. Conversely, a drop below support with accelerating outflows would suggest that the market needs a deeper reset before it can climb again. Long-term investors may view this environment differently. For them, compressed volatility and sideways price action can be an opportunity to build positions gradually, rather than chasing breakouts. The main risks to monitor are persistent ETF redemptions, more aggressive target cuts by major institutions, and any macro shock that tightens financial conditions faster than expected. Bitcoin softening near $92,000 does not automatically mean the bull market is over. It means the narrative is being tested. Big banks cutting targets, ETF fatigue, and stretched treasuries are forcing everyone to separate hype from reality, while firms like Bernstein remind the market that cycles can last longer than most people expect. If this video helped clarify what is really driving Bitcoin right now, consider subscribing, hitting the like button, and sharing it with someone who is still expecting an automatic year-end melt-up. Drop a comment with your target for Bitcoin into 2026 and whether you think this is just a pause or the start of a much bigger reset.